Hey everyone, Simo here from Investment Research. This is Tuesday, November 25th. Please guys, before we start, if you found my analysis helpful and with some value, I invite you to subscribe. Alright, from what I'm seeing right now, because there's a fundamental shift happening in the lending market that's being completely overlooked, and honestly, I think this creates one of the better risk-reward setups we've had all year. The stock closed yesterday at 27.37 after an 8.6% surge, and today we're holding those gains pretty well. But forget the daily noise for a second. What matters is the macro wave building underneath this company, and I want to walk you through exactly why I think we're at an inflection point. And let me get straight to what's driving my conviction right now. The lending sector is about to experience its strongest growth cycle since 2020, and SoFi Bank is positioned right at the center of it. According to the Mortgage Bankers Association, mortgage lending is projected to surge 28% in 2025, hitting 6.52 million origination units versus 5.09 million this year. That's not a small bump. That's a massive expansion driven by the Fed's rate-cutting cycle that started in September and is expected to continue through next year. Lower rates mean refinancing explodes, home purchases accelerate, and loan demand across personal lending picks up dramatically. Here's why this matters specifically for SoFi. While traditional banks have been sitting on the sidelines being cautious, SoFi has been aggressively building their lending infrastructure and member base. They've got 12.6 million members now, up 35% year over year, and they're managing over 18 million products. When this lending wave hits, they're not scrambling to build capacity like competitors. They're already scaled and ready to capture market share. TransUnion just forecasted that unsecured personal loan originations will continue growing strongly in 2025 after seeing 15% growth in Q3 alone. SoFi dominates in the prime borrower segment of personal loans, so they're going to grab a disproportionate share of that volume. What really caught my attention this morning was Truist cutting their price target from 31 down to 28 while keeping a hold rating. Now, I know some people panic when they see target cuts, but let me explain what they're actually saying. They're worried about tough growth comparisons because SoFi's loan platform business had monster gains last year, so the year-over-year math gets harder. That's it. They're not saying fundamentals are breaking or the business is deteriorating. Here saying when you grow 38% one year, maintaining that exact pace the following year is mathematically challenging. Every high-growth company faces this. It's called the law of large numbers. And frankly, if that's the worst criticism an analyst has right now, I'm not concerned at all. What I am focused on is the institutional buying wave that's been building for the past 2 quarters. JP Morgan increased their stake by 881% in Q3, taking their position from under 5 million shares to over 46 million shares, now worth over $1.2 billion. Vanguard added another 800,000 shares, pushing them above 100 million total. ARK more than doubled their position. These aren't retail traders chasing momentum. These are sophisticated institutions with teams of analysts running detailed financial models, and they're accumulating shares after the stock already ran substantially. That tells me their forward-looking projections justify current prices or see significant upside ahead. Now let me connect this to what's happening in the broader lending environment, because this is the piece most investors are missing. Consumer lending is expected to pick up meaningfully in 2025 according to every major forecast I'm tracking. The Fed's rate cuts are flowing through to lower borrowing costs across mortgages, personal loans, and auto financing. Credit card debt hit $1.17 trillion with average rates at 24%, so debt consolidation through personal loans is becoming massively attractive. SoFi specializes in exactly this product, targeting prime borrowers with weighted average VICO scores of 745 who are looking to refinance high-interest credit card balances into lower-rate personal loans. That addressable market is exploding right now. Here's what separates SoFi from traditional lenders in this environment. They're not just a loan originator, they're a full financial services ecosystem. Someone refinances their credit card debt through a personal loan, then they move their checking account to SoFi to get a higher interest rate on deposits, then they open an investment account, then they apply for a credit card. The cross-buy rate sits at 40%, meaning 40% of new products come from existing members. That flywheel effect is incredibly powerful because once you capture a customer, you're monetizing them across multiple products with minimal additional acquisition cost. Traditional banks simply don't have this digital-first integrated platform advantage. The fee revenue transformation is accelerating faster than Wall Street is modeling. Fee-based revenue hit $409 million in Q3, up 50% year over year and now representing 43% of total revenue. This is critical for valuation because fee income from wealth management, payment processing, and subscription services gets rewarded with premium multiples. Banks generating substantial fee revenue trade at significantly higher valuations than pure lenders because the earnings are more predictable and less capital intensive. As the company pushes that fee revenue mix toward 50% and beyond, the market will have to revalue the business away from a lending multiple toward a fintech platform multiple, and that spread is substantial. Let me address the analyst rating picture because this is where opportunity exists. Current coverage shows 11 buy ratings, 11 hold ratings, and 6 sell ratings with an average price target of $27, basically where we're trading now. But that average masks huge disagreement underneath. The range runs from $12 on the bearish end to $37 on the bullish side. When you see that kind of dispersion, it means the market hasn't reached consensus on fair value, and that creates alpha for investors who understand the drivers. Several major firms raised targets recently. Goldman went to 27 from 24, UBS moved to 27.50 from 2050, Mizuho jumped all the way to 38 from 31, citing rate-driven tailwinds and positioning to benefit from Fed policy. These aren't minor adjustments. These are material revaluations as updated models incorporate improving fundamentals. What I find most compelling about the setup right now is that SoFi's credit quality actually improves in a lending expansion cycle when you have their borrower profile. They lend primarily to high-income, well-educated borrowers with strong credit. Personal loan net charge-offs declined 23 basis points to 2.6% in Q3. The weighted average income of borrowers sits at $157,000. In an environment where the Fed is cutting rates to support growth but employment remains relatively strong, these prime borrowers are the sweet spot. They have stable jobs, they can handle debt service easily, and they benefit disproportionately from lower rates because they actually qualify for the best pricing. Subprime lenders face elevated default risk in any economic slowdown. SoFi's borrower base is far more resilient. The technology platform business is another growth driver that doesn't get enough attention. Through Galileo, SoFi powers financial infrastructure for major brands. They just launched co-branded debit cards with Southwest and United Airlines running on Galileo's tech stack. Management mentioned on the Q3 call they've signed 2 more major consumer brands that haven't been announced yet, and they described them as their largest deals to date. This B2B revenue stream is growing double digits and adds meaningful diversification beyond the consumer app. Once you build infrastructure for enterprise clients, switching costs are prohibitive, so these relationships are extremely sticky and high margin over time. Now let me talk about what I think happens from here because this is what investors actually care about. The stock pulled back from $33 to $25 last week, which gave us about a 23% discount from the recent high. Yesterday's 8.6% surge took us back to 27, and today we're consolidating at these levels. In my view, this consolidation is healthy and necessary after the run we had. What matters is whether the fundamental drivers support higher prices over the next 6 to 12 months, and based on everything I'm seeing, the answer is yes. The lending market expansion happening in 2025 is a tailwind that's worth multiple billions in incremental revenue opportunity across the industry. SoFi is positioned to capture disproportionate share because they scaled capacity ahead of the wave, they target the highest quality borrowers who benefit most from rate cuts, and they monetize customers across multiple products rather than just originating a loan and moving on. Fee revenue is growing 50% annually and approaching half of total revenue, which should drive multiple expansion as the market reprices the business from a lender to a platform. Institutional investors are building billion-dollar positions after doing deep diligence, which validates the long-term thesis and provides price support. Wall Street consensus sits at $27, but that average hides analysts with targets as high as $37 and $38 who see the full platform value. If SoFi executes over the next few quarters, maintains that 35+% revenue growth, pushes fee revenue above 50% of the mix, and continues adding millions of members, I think the stock works its way back toward that $30 to $32 range we saw a few weeks ago. Beyond that, if the lending expansion materializes the way forecasts suggest and they gain meaningful share, we could see sustained momentum into early 2026. The risks are real and need to be acknowledged. Valuation is elevated at these levels, so execution has to be flawless. Any stumble in member growth, deterioration in credit metrics, or slowdown in the lending market recovery, and the stock could give back gains quickly because there's limited margin for error priced in. Competition is intensifying as traditional banks improve digital offerings and other fintechs fight for the same customers. Regulatory changes around digital banking or any unexpected macro shocks could create headwinds. You also have to consider that the stock ran over 400% in 3 years, so some consolidation or profit taking should be expected even if the long-term story remains intact. Here's my judgment as an analyst who covers this space daily. At $27 after yesterday's surge, I think the risk-reward still favors the long side if your time horizon is 6 to 12 months minimum. The fundamental business momentum is strong, the macro environment is turning supportive for lending, institutional validation is building, and the valuation, while elevated, is potentially justifiable if they deliver on the growth and margin targets. This isn't a stock you buy with your entire portfolio because the volatility is real and the valuation leaves no room for mistakes, but as a core growth position for investors who believe in the digital banking transformation and think SoFi executes well, I think current levels represent a reasonable entry point. For those asking whether this week will be green, honestly, I can't predict daily or weekly moves with any certainty. Short-term price action depends on macro news, broader market sentiment, technical trading patterns, and general fintech sector momentum. What I can say is the stock has institutional support around these levels based on the buying we've tracked. And if the broader market cooperates without any major negative catalyst, we could see gradual appreciation back toward that $30 area over the coming weeks. The path won't be straight up, but the fundamental setup supports higher prices if execution continues. On whether you should buy the dip, here's how I'd approach it. If you have no position and believe in the thesis I laid out, using this pullback from 33 to establish an initial position around 27 makes sense. You're not chasing all-time highs, you're not buying peak momentum, and you're getting in after a correction that flushed out weak hands. I'd suggest scaling in rather than buying everything at once, because the stock could dip another few dollars before it moves sustainably higher. If you already own shares, I wouldn't be adding aggressively here unless you're underweight relative to your conviction. The stock has had a massive run, and patience probably gets rewarded with better entry points over the next few months. What I'm watching most closely going forward is that lending volume data as we move into 2025. If mortgage originations and personal loan demand actually surge the way forecasts suggest, SoFi should see material revenue acceleration, and that becomes the catalyst for the next leg higher. I'm also watching fee revenue as a percentage of total revenue because hitting 50% fundamentally changes the valuation framework. Member growth and product adoption rates matter because the platform only works if people are actively using multiple services. And credit quality is always important to monitor, especially if we see any economic softness, because even prime borrowers can struggle if conditions deteriorate. The bottom line is this: SoFi is executing on building a full stack digital bank targeting prime millennial and Gen Z customers who will never walk into a physical branch. Revenue is growing nearly 40%. Profitability is expanding every quarter. The product suite keeps getting broader, and major institutions are allocating serious capital after the stock already ran substantially. The lending market is about to experience its strongest growth since 2020, driven by Fed rate cuts, and SoFi is scaled and ready to capture a disproportionate share. Valuation is elevated, but potentially justifiable if they deliver. The setup favors patient investors who can look past near-term noise and focus on the multi-year transformation happening with this business. As always, this is my analysis based on the data I'm tracking and the models I'm running. You need to do your own research, understand your own risk tolerance, and make decisions that fit your specific financial situation and investment goals. I'm sharing what I see, but ultimately you're responsible for your own capital allocation decisions. And that's the analysis for today. Thanks for listening, and I'll be back tomorrow with more investment research.